Hey, party people, Ben from Pivot, and I wanted to put together this summary of the federal budget that's just been released by the good Dr. Chalmers. And yeah, look, there's a bit to it in some ways, but in other ways, it was a bit of a boring budget, if I'm being totally honest. Uh, Basically, in spite of all of the strong economic performance that we've been seeing over the recent past, particularly with really high commodity prices, there's a lot of talk of the downside risks to the economy and the budget bottom line over coming years, and particularly off the lessons from the UK situation where they splashed out a bunch of cash to stimulate the economy when they're anticipating more of a decline. But doing that with borrowed money, the markets didn't like it. The government, the prime minister got punted as a result. And I don't think anyone in the Labor camp wanted to go down that path. So they have been pretty considered and measured, and I suppose not pulling the trigger too much on spending, as opposed to some of the cash slashing budgets that we've seen through the COVID pandemic in particular. There's a few things at play here. One of them is that given that we're in almost $1 trillion of debt in Australia, and the fact that interest rates are rising, the government interest bill is increasing to around $70 billion in annual interest payments, which is pretty staggering. It shows that the budget will remain in deficit for a few years to come, driven by some of those interest costs. Also, massive blowout in the NDIS program, which is forecast to reach annual spending of like $50 billion a year, which is huge. Nothing in the budget really to address that, but hopefully something is coming there. So they promised a boring budget, and they really didn't disappoint on that one. There was a lot more money for them to work with than what was forecast in the March budget put out by the coalition government. But all of those funds have largely been returned to the bottom line, shoring up debt, shoring up the budgets, the government's cash balance, essentially. Some of the interesting forecasts, though, before I get into the nuts and bolts of the budget measures, some of the interesting forecasts that I was looking at, the cash rate is forecast to peak at 3.25% in early 2023. So it looks like we've still got a bit of a rise to come there. Inflation to peak just below 8% in the December quarter of 2022. We just saw the inflation stats come out yesterday at a higher than expected pace. So and showing that inflation is still accelerating, which it is in Australia, both headline inflation and underlying inflation. Two important measures there. Economic growth and unemployment. So economic growth is due to drop and unemployment is due to rise next year. I think from my take on looking at the stats in the budget forecast, I think that the government is hoping that those figures will be better than what they've forecast, but they're being pretty conservative, which probably makes sense. Also, commodities are projected to go down by somewhere between 1/3 and 50%. So a pretty massive drop to commodity prices really early in 2023. There is some significant upside to the economy in that not happening. And it seems like a pretty high likelihood. It's obviously pretty difficult to forecast commodity prices, but given the ongoing conflict with Russia, Ukraine, if prices continue to stay higher for longer, that actually does really good things for our economy and the budget bottom line. So it could mean that there's some potential upside there for the government and for Australians as a result. Headline wages are forecast to rise, but real wages are still due to go backwards for some time to come due to the sky-high inflation that we're seeing at the moment. And unfortunately, for basically all households, power prices are set to rise by 56% by the end of next year, basically. Labor is talking about intervening in markets to help bring those prices down, particularly some of the costs of gas prices, but time will tell on that one. So into the budget measures, and one thing that I was very pleasantly surprised to not see in there was changes to the stage 3 tax cuts. So Dr. Chalmers has come out and ruled out changes to the stage 3 tax cuts, which he says, and I quote, the government has more pressing priorities in the interim. These tax rate changes are due to come in 2024-25, where basically the 37% tax bracket is scrapped, and for people with income below between 45,000 and 200,000, they'll all pay a 30% tax rate. Game on. This means that the measures are due to cost $21 billion a year. There was a bit of talk leading up to the budget about potentially winding those back, but that creates a lot of opportunity when it comes to growing your investments. And given particularly, inflation and this bracket creep that we're seeing, it will be some welcome news for people that are trying to actually build their wealth and get ahead. Talking property, and one of the big headline grabbing announcements that they made was this target of building 1 million affordable homes over a 5-year period from 2024 under this big housing accord. There's a few interesting points to unpack here. The first is that to build 1 million homes in over 5 years, the target for building homes is 200,000 new homes a year. Looking at the stats from last year, the 175,000 homes were built. So it's actually not that much of an increase. They sort of touting it as this massive measure that's going to have this huge impact, but it's actually not that much of an increase. So worth calling that out. Other interesting part of this is that super funds are getting heavily involved here, getting into the residential property space. So this is a trend of where super was the first big mover in this from a super fund space. Now we're seeing this accord with the industry super funds in particular, and all of Labor's buddies in the trade unions and their mates at the industry funds. Leaving that aside for a second, you can see that obviously the dynamics of this investment is stacking up. And this is a trend that we're seeing around the world. It suggests as the big instos are getting more into property space, it makes it harder for individuals to buy property. So we've seen in other countries where instos start getting heavily involved, property starts just getting more and more out of reach. So my take on this is if they're seeing that the numbers are stacking up as a good investment, appreciate that getting in the property market can be hard, but you want to get your skates on so that you get in before you get left behind. Talking though, in this measure, there's some commentary from builders that have come out saying that they're keen for this, obviously, to do more work, but they won't be able to increase supply or construction of new homes to that level without addressing skill shortages and land supply issues as well. So time will tell if they're able to deliver on that promise. This measure will mainly impact renters. So it makes rent more affordable by having more properties available in the market. A couple of other smaller measures, electric vehicles. There was a big provision put in place to basically for any electric vehicles that have a retail price below the luxury car tax threshold, which is about $70,000 from memory, maybe a little bit more than that. Don't quote me on that one, but somewhere around that number. Basically, there will be no tax that applies on those electric cars. So if you're hanging out for a Tesla, as long as you can put up with a 12-month wait, then things just got a little bit more affordable. Also, TAFE places and uni places, there's 480,000 fee-free TAFE placements to be created in recognized trade areas, and $40,000 grants for teachers that are looking to go to uni to do their teacher training, essentially available to anyone with an ATAR over 80%. There's 5,000 places a year under that scheme. So some welcome news there, and hopefully helps to address the shortages in the education system as well. Paid parental leave was another big one that was spoken about. Paid parental leave and childcare as well. Paid parental leave is being increased from 20 weeks to 26 weeks. So basically 6 months under the paid parental leave scheme. It kicks in, or it starts increasing from 1 July 2024, and then the scheme is going to be another 2 weeks is added on every year until it reaches the full 26 weeks by July of 2026. That's said to get provide benefits, obviously, to families and workplace participation. I haven't seen the detail come out, but there's some talk about for couples where care is split between mum and dad, that there's some provisions in there around that as well. Also, talking childcare, which is a huge cost for a lot of families, the income threshold above which the subsidies for childcare cut out has increased to a dual income threshold of $350,000. Also, any parents that previously that earn more than 156,000 unable to access the paid parental leave scheme. So it's going to mean that parental leave subsidies, parental childcare subsidies are available for a lot more people. Also, from July 2023, the subsidy rates increasing up to 90% for families earning less than $530,000, which is obviously a pretty cracking income. So a lot of people are going to be caught up in that, which is good. Also, the childcare thing in particular should increase workforce participation and workforce participation by females in particular, adding about 37,000, the equivalent of 37,000 job places to the workforce, which is awesome to see. One of the other budget measures was this crackdown of big business and dodgy taxpayers. Basically, if your tax planners or tax agents are being coloring too far outside the lines when they do your tax returns, then the ATO will be watching. This is going to net apparently $4.7 billion over 4 years, and particularly looking at tax avoidance and multinational companies in this space and making sure that they're paying their fair share of tax. And the last one, and an interesting one, the first time Bitcoin was mentioned in the budget, with the government confirming that they will enshrine the tax treatment of Bitcoin as an asset and not as a currency, which means that investors will pay capital gains tax and get access to the long-term capital gains discount. So welcome news for any crypto traders that are in profit. There's a few less of them this year than there were last year, but moving forward, it's good to see that making some progress there. Guys, there's more coming out on this, and I hope that it helps to understand at least the key measures and what they actually mean for you. I'll catch you next time. Bye for now.